Risk management in banking companies. Are there? 1. Identifying risks. For banking companies, identifying and evaluating risks like credit market, operational, liquidity, and compliance risks is the initial step toward effective risk management. 2. Credit risk management. Banking companies focus on credit risk, managing it by assessing borrowers, setting limits, and monitoring loans to minimize defaults and non-performing assets. 3. Market risk management. Market risk, driven by interest rates, forex fluctuations, and market price changes, prompts banking firms to employ strategies like hedging for exposure mitigation. 4. Operational risk management. Operational risk, covering internal processes, systems, and human error, leads banking firms to adopt risk management practices to prevent errors, fraud, and operational disruptions. 5. Liquidity risk management. Liquidity risk is the fear of not having enough cash for short-term obligations, so banks maintain plans to cover withdrawals and expenses. 6. Compliance and regulatory risk management. Banking companies implement compliance risk management procedures to prevent legal consequences by ensuring strict adherence to laws and regulations. 7. Risk measurement and quantification. Banking companies employ quantitative models and risk assessment tools to measure and quantify risks, aiding in evaluating the potential impact on the institution's financial health. 8. Risk mitigation strategies. Banking companies reduce and transfer risks by diversifying loans, hedging, and implementing controls after identifying and measuring potential threats. 9. Stress testing. Stress testing evaluates a banking company's balance sheet resilience in adverse economic conditions, revealing vulnerabilities and ensuring sufficient capital adequacy. 10. Capital adequacy planning. Banking companies maintain sufficient capital to absorb losses, with capital adequacy planning as a key element in risk management and regulatory compliance. 11. Regulatory compliance. Banking companies facing significant compliance risk prioritize monitoring and adherence to numerous financial regulations as part of their risk management practices. 12. Risk governance. Clearly defining roles and responsibilities for risk management is crucial, with the board of directors overseeing and dedicated committees managing risks within the organization. 13. Reporting and communication. Risk management requires clear communication of risks and mitigation strategies to the board, management, and regulatory authorities for effective oversight. 14. Continual monitoring and review. Risk management is continuous for banking companies, involving constant monitoring, review, and adjustments to adapt to changing market conditions and emerging risks. 15. Customer data security. Protecting customer financial data is an essential aspect of risk management, as data breaches can have severe financial and reputational consequences. 16. Stress testing. Stress testing evaluates a banking company's financial position and capital reserves under extreme conditions, pinpointing vulnerabilities and guiding strategic capital planning.